Hey, Inspired Moneymaker. Our guest says that blockchain is the single largest value creation event of our lifetimes. We're going to learn why he's uncovering opportunities in making seed investments in early stage blockchain startups. Episode 264 features Rob Frasca, veteran, entrepreneur, venture capitalist.
I got to laugh because all my friends that are venture capitalists, I was the EIR with Highland Capital. Over the years, you build a pretty good network of venture capitalists. And they would all, laugh at me like, what are you, crazy? It's hard enough to raise money into a fund, but now you're tokenizing it? Like, how are you going to explain that? My mentality as an entrepreneur was, if I'm going to invest in this stuff, I should know how it works. So by being an early adopter of tokenizing Cosmo X, my team and I, we know the legal issues, we know the workflow issues, we know what companies are in the space, which ones are doing what tech, which ones work, which ones don't, what their product roadmaps look like. So now I'm informed all from deciding to tokenize my fund.
I'm Andy, host of the Inspired Money podcast, where we share positive perspectives on money so we can make a bigger impact in our communities and in the world. This episode is brought to you by my company, Runnymede Capital Management. Individuals, families, and business owners hire us to manage their investments through full market cycles. We are fee-only advisors. If you're on LinkedIn, follow me at linkedin.com/AndyWong888. That's ANDYWANG888. Or just search for Inspired Money and you'll find me. Let's connect, because you never know when I or one of my connections can help you out or we can help each other. As always, please let me know if I can be of help to you and your finances. Today we're talking with Rob. He's a serial entrepreneur who has built and brought 3 venture-backed startups to successful exits. He's the co-founder and managing partner of Cosmo Ventures, a venture capital firm that specializes in investing in promising blockchain technologies and cryptocurrencies. Cosmo's early-stage venture capital fund is tokenized, meaning investors can purchase a token on an exchange platform like Coinbase Pro and own a share of economic interest in the VC fund, a cutting-edge way to bring VC-level opportunities to the masses. I think you're going to enjoy hearing Rob's views on money and getting a venture capitalist's views on the opportunities in blockchain and crypto. If it's early, it will pay to keep our eyes and ears open for the blockchain equivalent of the internet's Google, Facebook, Amazon, or Apple. In this episode, you'll learn about an entrepreneur's views on getting paid to create value, why Rob is so excited to invest in early-stage companies focused on blockchain, crypto, cybersecurity, and artificial intelligence. And then make sure you tune into the end to learn about the benefits of tokenizing a venture capital fund. Now let's get inspired with Rob Frasca. Rob, welcome to Inspired Money. I'm so excited to have you on the show.
I'm thrilled to be here. Thanks for having me.
Let's jump right in. What's your earliest childhood memory of money?
Man, let's see. I'll tell you. So when I was a kid, my mom had 2 jars she would in the kitchen, and she would put money in there, and she would put my allowance in there, like a little bit of money in there. And then she would always put another equal amount in another jar that I would give away. So I kind of learned about money through that kind of system. And I think thinking back, probably the earliest is looking at that jar, trying to figure out how much was in there because I wanted to buy a toy. It was like a little spacecraft type of toy. And always every day kind of looking at that jar saying, okay, is there $5 or whatever, $10 that I needed, to buy that toy? I would have to say that's probably my earliest memory about money.
But there was a component of saving, but then also earmarking some to give away.
That's right. My mom and dad always said, they never went to college or anything, but they were pretty astute. And they said, look, money is like energy. And in order to get money, you got to give money. It's about flow and bringing flow into your life, getting and giving. And so you need to kind of think that way. And I always learned that early on, never really thought it was unusual until I got older. And then people are like, wow, that was kind of cool.
That is a really cool idea to get when you're young. And then I'm curious, how did a Navy pilot become an internet entrepreneur and perhaps the earliest fintech entrepreneur?
Yeah, actually, so I was always very entrepreneurial person. Always cutting lawns to make money and doing stuff to make money and starting little businesses here and there. And I was very entrepreneurial in the Navy, in flying, and developing different systems to do different things. And then the Navy sent me to Carnegie Mellon to get to teach ROTC there, and I got my MBA at night. And I saw the internet for the very first time. Now, this is 1992, right? This is pre-Netscape. This is pre-Yahoo, just around Mosaic came out. And I was just completely blown away by the promise and the vision of it. And so, one of the things about being a pilot is you get really what they teach you is to be very comfortable with a lot of uncertainty, right? Because you think about it, you're flying a jet, there's a lot going on, and you can't be a control freak in a lot of ways because you can't. There's just too much going on to control it all. So you really learn how to make these decisions with all this uncertainty, which is really what being an entrepreneur is a lot. So for me, it wasn't a big leap to go from that to, starting a company. And we actually started like you said, the very first financial service on the internet, first stock quote server, first one to put on the World Wide Web, which was crazy. And, thinking back now, right, where we've been. And even then I thought, holy cow, this is going to change the world. But I undershot to what it actually has done. In terms of how it's really affected the world.
In terms of the pilot training translating to becoming an entrepreneur, do you actually view risk much differently? Because as an entrepreneur, probably you're not going to die. You know what I mean?
That's right. Well,
you put it in perspective.
You also, you become less sensitive to risk, right? At the end of the day, I say to my wife, well, what's the worst that can happen to me here? I'm still alive, right? I didn't crash into a boat somewhere or get shot down by a missile. So yes, it does have a way of kind of dampening what real risk is. But more importantly, I think, like I said, it gives you the confidence to know that you can control this and focus on what's at hand right now. And don't worry about stuff that isn't going to kill you right now. You know what I mean? And it's the same thing in being an entrepreneur. Focus on what's important today. It's all about prioritization because you only have so many cycles to really think about it. I have a list of axioms, entrepreneurial axioms. So I've done a bunch of businesses. I think I've lost count, 5, 6, 7 different businesses. And so I have these little axioms that I talk about. And my first one is this. The first thing they teach you in flight school is only an idiot runs out of gas in an airplane. And that's actually my first rule of being an entrepreneur. You got to have cash, right? It's all about cash flow. It's about managing how much you're spending versus how much you're making and what your runway is, and taking that to success. So there's a lot of little nuance kind of things you learn as a pilot and in life that play well to being an entrepreneur.
With the stock and mutual fund information database, you must have been in your mid-20s, and it doesn't sound like you grew up wealthy. How did you raise the money to do that?
Yeah, my parents were blue collar. I was the first male in my family to go to college. Certainly, I was middle class. I wasn't poor, I wasn't rich, but middle class. And when we, this is in 1992, 93, when we built the site, it was called NETworth. The name of the company was GALT Technologies after John Galt. I was a big fan of Atlas Shrugged. Anyway, the venture capital market wasn't like it is today. It was very small. And there was a small VC firm. And I knew going to B school, I wanted to leave the Navy and I wanted to do one of two things. I wanted to become either a venture capitalist or an entrepreneur. And so I got kind of an internship working with a VC firm, unpaid internship, working with a local VC firm called Point Venture Partners, and started working on this company. And I remember having a conversation with Kent Engelmeyer, who ran the firm at the time. And he said to me, go be an entrepreneur and learn how to build companies first. And then take that knowledge, you'll be a better investor. And so that's what I did. And he actually was the one, he didn't even invest equity. He gave me a $500,000 convertible note into the company. And that's how we got it started, which was huge back then, right? You know, and then I was lining the company up for a larger round of $3 million from another venture capitalist. At that time, we had signed up Charles Schwab and Vanguard and over 100 financial institutions to this system. And Intuit came in, Bill Harris and Bill Campbell, Scott Cook, called me one day and said, nah, don't take that money. We want to buy you. And so here I am, 29 years old, with $500,000 convertible note, but selling the company for, I don't know, I think it was around 15 million bucks at the time. We were the number 2 internet acquisition. So in the history of the internet, it was way early. In hindsight, I probably should have not sold, took the money and took it public, a year later. But hey, that's axiom number 2 is eat when served.
It's still not a bad exit. And was that just 2 or 3 years in? It wasn't very long.
Yeah, it was 2 years in. Here's a funny thing. So here I am. I want to put a stock quote server on the internet. So I go to New York and I meet with S&P, and I say, hey, look, I need a stock quote engine because I want to put this out on the internet. And my partner at the time, a gentleman named Joel Mask, and I, we started together. We're co-founders, and we chose financial services because financial products are information, and the internet is information based. So that's really why we went after it. But anyway, I went to them. I said, look, I need a stock quote server. I'm going to put it on the internet. And the guy says to me, what's the internet? And I said, don't worry about it. It's just an academic network, and I want the exclusive. And he says, no problem. Here you go. So I signed a contract to get S&P information and put it on the internet in 1992 from S&P. And about a month after we had it up and running, I get a call. And they're like, are you delaying the quotes? And we're like, well, what do you mean delaying the quotes? And they said, well, it's supposed to be delayed. And we're like, well, okay, you want us to write the code to delay it? We thought that they were. Anyway, they were upset because we were putting real-time quotes out on the internet, and then a week later we got a nasty gram from them saying, well, you're putting the Dow Jones average out there, and we don't have license to that, so you got to take that down. So we had, we had it in a big banner on the website, Dow Jones average. So anyway. 1993, crazy, right?
There are advantages to being early, but then it sounds like a real adventure too.
It was, yeah, it was an adventure. And as a 29-year-old guy, it was definitely a good education.
And then you went on to help build WiseWire, an early AI web search technology company that sold to Lycos. I saw in 98 for almost 40 million?
Yeah, actually, so it sold for right around 30 million in stock, Andy. And the stock was locked up. And so we sold it to Lycos. The stock was trading at around $7, $32 million at $7. And when the lockup came off the stock, the price was right around $68. So this little $32 million transaction wound up being, close to 300, maybe a little more than 300 million all in.
Wow. Could you sell your stock or did you hold on to
Yeah,
it?
so I was senior as a result of the acquisition. I wound up becoming general manager of Lycos, working directly for Bob Davis, the CEO. So here I am, this 29, 30-year-old guy running all of Lycos.com, some 450 people, $150 million P&L. We were the number 2 search engine behind Yahoo. In fact, at one point we beat Yahoo at that time. And and I was Rule 144, so I couldn't sell. I had to sell on a program schedule because I was an insider. But we did manage to sell, on a regular kind of schedule. So it wasn't a bad thing. It wasn't a bad thing. Yeah.
So in a very short period of time, you created a lot of wealth.
Yeah.
Does this go back to the idea of money is energy and that it flows? How did this inform your views on money as a young guy who grew up middle class?
Yeah, ultimately, I think money is value and energy, right? And if you're giving a lot of value and you're creating a lot of value and you're delivering a lot of energy and giving energy, it comes back to you. It's a flow. And that's how I think about it. And for me, I've always been a pioneer. I've always been a creator. I like to create things. I wake up in the morning, I want to create something. I want to build something, or I want to help people who are building something build it. I get all my enjoyment in life with creating things out of nothing. And so when entrepreneur today as an investor, I love it. I sit down with young investors who are scrappy like I was, and they're like, yeah, we got this, we got that. Here's what we're going to do. And here's the bigger vision. There's nothing more exciting than that. And that's where the alpha is, right? I mean, real alpha at scale, is all about, those kinds of early creations and really, leveraging how technology changes society. I was fortunate to be part of the internet. I was and before that, I was early PC. I had a Apple One and then an Apple II. So I've always been on that kind of cutting edge. But for me, it is all about product adoption. It's how it changes society, and wealth just comes when you create that value. Don't get me wrong, it's not easy. It's hard. It's really hard to do. And, social media and the press and the news, they love to really focus in on, the billionaires, the success, right? That's what we're all interested in, is the success. There's not a lot of people talking to the guys that failed, but the real action is there. The real action is in the failures. It's in the trials, the tribulations, the sweat, the blood, the drama of creating something. That's where the action is.
Any big failures in your career or axioms that really talk about failure?
Yeah, I've had a bunch, and I've had a lot of struggles. When I was just leaving Lycos. It was about 1999, 2000. If you remember, dot-com bubble popped right in 2000, March in 2000. And I decided to leave Lycos and start a company called Internet Venture Works, which was really aimed at helping real world businesses leverage the internet to reinvent themselves. So, and I raised a bunch of money from private equity, traditional private equity buyout folks. And the market went away. Dot-com bubble crashed, capital markets closed up, liquidity went away. And it took a good 2 or 3 years for it to really come back and come back stronger. But for me, in that 2 to 3 year period of time, the business model that I had raised all that money on was not going to fly. It just wasn't going to work. So I actually handed the capital back. I remember going to my investors and they were like, wait a minute, you're going to do what? Like, nobody ever gives the capital back. And I said, well, I can't sit here and look you in the eye and say this is going to work. And I don't want to go to work if it's not going to work. So yeah, let's hand the capital back, shut it down, and we'll go on our merry way and figure something else out. So that, I classify that as a failure, because, I didn't, return on capital was slightly less than one. So that to me is a failure.
You seem to have a knack for identifying these opportunities for value creation and really being willing to dive in.
Yeah, I love to dive in, right or wrong. Sometimes I dive in too much, but that's who I am. That's my personality. I would say if I were to evaluate myself, I tend to be too early. I tend to be too much of an a visionary, and I'm using visionary as a term, not myself calling visionary, but they say visionary, early adopter, early majority. It's a Jeffrey Moore kind of thing. I tend to be a visionary, early adopter. And as an entrepreneur, that's great. As an investor, you probably want to be a little bit later. So I tend to be a little too early on things, but that's okay. As long as you've got enough cash and staying power, fuel in the tanks, you can, eventually you'll catch the right part of timing. But timing is a tough thing as investors and as entrepreneurs, because hitting it just right where you're too early, too late, it's tough.
Rob, how do you know when you should be patient and really stick with it and be persistent because you're early versus identifying that it's not working and you need to really pivot and make a change?
I think you always have to pivot and change. Always, always, always be pivoting and changing. You see a lot of people write about this. In fact, Ray Dalio wrote a book, talking about this loop and his principles. And it made me laugh because, I love Ray Dalio, but he didn't invent that. Okay. It was actually invented by a guy named Boyd, a fighter pilot. And he wrote a book on fighter combat, which as a naval aviator, we all read. And it's called an OODA loop, OODA. You might have read about it. Observe, orient, decide, act. It's basically a way of adjusting and iterating and making small iterations. I actually think Ray attributed that to OODA. So I'm not slamming Ray on that. Ray, don't take offense. So for me, I've always lived that way in this OODA kind of world, and that's what startups are. So you're constantly observing where you are, you're orienting yourself to that problem, you make decisions and you act, and then you observe again. And so as an entrepreneur, nothing ever just happens. You just kind of iterate until something catches fire. And you ask the question, well, how do you know if the thing isn't going to work? Well, eventually you get to a point where you just realize this dog is not hunting. This is not working. And I think it takes real courage to say, no, it's not going to work. Let's move on. And I would say again, to evaluate myself, I've always been too late to make that call. And because of the emotional attachment and the people involved and the money involved, it's hard to say, I'm throwing in the towel. Hopefully what you do is you iterate away, or you iterate enough, you pivot enough to save the day.
To figure it out.
Yep. No, and it's really a mathematical, this is the Carnegie Mellon geek in me, or the Rochester Institute of Technology geek in me. It really is a math problem, right? Because you only have so much fuel, you only have so much cash to buy you so many iterations. And then you either got to raise more cash or, throw in the towel. So it's really math in a lot of ways.
So tell us about founding Cosmo Ventures and the opportunity there, because we've seen a crypto winter, and I'm so curious to hear, one, the opportunity, but then identify where are we?
Yeah, those are great questions. So look, remember I told you I'm a .com guy, and I'm also a mobile guy. Like I worked with a company called Vivox. We were voice over IP, sold to Unity. When you play a Fortnite and your kids are playing Fortnite, or you're smack talking that 12-year-old because he just killed you, the voice system for that, Vvox did. So I've done a bunch of companies, right? And so we're very experienced in this .com world. And the one thing that I've realized in doing this is that the one thing that the internet is, if you think about the internet, it's this really big decentralized network, right? There's very, and when you have this network and it's decentralized, what you don't want is central points of failure. Because if you take a bank, for instance, and you put it on a network, it becomes a honeypot. And then everybody goes to that honeypot and they hack it. And then you have a failure, right? So the whole idea of the internet was to create this decentralized network that didn't have a central point of failure. Well, it turned out that what we did was we layered on all our transaction systems on top of the internet, but they're all still centralized. So they're all breaking. In fact, they don't even report how much they're breaking because they don't want everybody to run away in fear, okay? So all of a sudden, this thing called Bitcoin pops out, and it uses the technology called blockchain. And what it really shows is that all of a sudden I can clear trades, I can clear transactions without a central point of failure, and without a central point of failure. This is just huge. Like this is groundbreaking, massive, massive invention. And so for us as .com guys, my partner and I and our team, we realize that I say all the time in the press, in interviews today, this is the largest value creation event in our lifetime because it's the value layer that's built on top of the internet. And we have already seen, you guys see the value of the internet. So for us, we said, we got to go after this. We got to invest in it. We got to go after entrepreneurs that are in this space. We have to really embrace this and really go for it. And so that's why we started Cosmo Ventures, was really as an investment firm. We started off as a holding company, investing our own money. And then we created a fund, a small fund to invest in it. And now we have a hedge fund to invest in the liquid side of it. So we really believe that blockchain is absolutely massive beyond the internet. So you asked, where are we? I still think we are super, super, super early. We always joke, man, I've seen this movie before. I've been in this movie before, and I know how it's going to play. I think the time today is really equivalent to that 1999 days of the internet, where you get a lot of excitement. You get a lot of irrational exuberance, to use that Alan Greenspan. You remember when he said that about .com? And then the bubble pops because we get too far out ahead of our skis. And the valuations come down. And then what winds up happening is we go from speculation to realization. We go from the vision of, holy cow, how this thing could change the world, to actually changing the world. And so at that point in time, that actually happens to be the best time to be an investor. What did Warren Buffett say? I always get the order wrong. Be greedy when others are fearful, and be fearful when others are greedy. I think it's the other way around. But right now there's a lot of fear, right? That's another thing that happens today. People invest today. It's all sentiment. It's not fundamentals. It's not what's going on. It's all, groupthink on Twitter. Right, unfortunately. And if you can get above that and really see what's going on, that's where you're going to get this alpha, right? So look at the indicators. You've got Goldman Sachs, you got JP Morgan, you got State Street. State Street's got over, $50 trillion custodial bank. You have BNY Mellon, you have Aberdeen, you have these major financial institutions. You have Larry Fink of BlackRock saying tokenization's the future, right? All of them have armies of people that they've hired that are building out, utilizing blockchain technologies to reinvent the financial infrastructure that we have. That again is the retooling. It's the value creation event that we're looking at. So long-winded, but I really truly believe that. And so what we're trying to do here with Cosmo is give the investor the ability to take part of that, right? It's easy enough for a venture capitalist to go in and say, yeah, I'm going to invest in that and make billions of dollars. And it's great for family offices to be able to do that. But why not, high net worth? Why not other investors to be able to come in and really take part of that value generation, if you will?
As a venture capital investor in early stage blockchain opportunities, and then you mentioned all the institutions, these huge banking institutions. What are the discussions being had among VCs in the institutions right now?
Yeah, so the institutions are looking for technology to solve their problems. There, and the VCs are working with entrepreneurs who are solving those problems and stitching those pieces together. So what we do is, as investors, is we have conversations with those larger institutions to better understand what problems they're solving and how they're going to stitch things together, because not everybody has a complete solution. And so that informs us in our ability to make investment decisions. Right. So, you might have, and I'm just using, stupid example here just to kind of illustrate, but maybe you're talking to a big institution and they need a wallet company, and the wallet's got to do X, Y, and Z to solve their problem. And I'm keeping it non-technical here. Then we may want to go out and look for a wallet company that solves X, Y, and Z, and maybe introduce them to the big company, and then ultimately, they get adoption. Right. We're an investor in I'm a Carnegie Mellon guy. And Hedera is a high-speed, world-class blockchain solution, okay, called Hashgraph. It's actually not blockchain, but anyway, it's called, I think it's HBAR is the crypto for it. And they're really focusing on, broad-scale institutional adoption, folks like, a Fidelity or an Aberdeen or what have you. And so, those types of layer one technology, infrastructural technology for us, it's easy for us to make that decision to invest in that, because ultimately that's the kind of technology that one of these bigger institutions will adopt. And so, again, you can see how that value is being created. There's some nuances. There's some nuances to this market that a lot of people don't understand. And that is, remember, the whole world used to be based on companies and central points of value, right? Niall Ferguson wrote a great book. I think it's called The Tower and the Square. The Square and the Tower. Maybe I get mixed up. It's around here somewhere. I don't know. I have it around here, my bookshelf. But basically what he talks about is throughout history, there were towers, corporations, where the power sat. And down below the tower, there was a town square of people. And they were, merchants and that talking. And he said that the network of that people in the town square was really where ultimately the value was created, not inside the tower. Well, think of it in terms of the internet and these big central institutions. In our mind, we're all used to companies. We're used to big institutions like Apple and Google and others that are creating value. But what blockchain is all about is the value being created and accreted to the network itself and everyone on the network. And so that, from an investor perspective, that's what crypto really represents. What crypto represents is the share of value of the network, which is a deep concept. But I promise you, in 10 years, everyone will know that concept and know it well. It's kind of like saying today, all the value of Facebook gets attributed to its stock and its shareholders. Imagine if, instead of doing it that way, Facebook was completely decentralized and all the value that was generated in Facebook was actually directly attributed to the people on the network. That's what we're talking about.
I've spent my whole career trying to understand how to value a company based on its earnings stream and its revenue.
Right.
To wrap my head around how do you value a network, it's a totally different animal.
It's a totally different animal, right? You got to look at how many nodes are on. Not all nodes are the same. You have super nodes, super connecting nodes. Some nodes provide more value than others. How fast is it growing? What's its velocity? Is it growing? Is it stagnating? There are all kinds of ways to look at what's the value being generated by that network. And by the way, you may have a network that has a lot of velocity, a lot of transaction throughput, and the price of those transactions are very low. And there might be trillions of people or trillions of nodes on that network, and it's incredibly valuable, right? You would think lots of nodes, lots of transaction value, boom, it's really valuable, right? But you might also have a smaller network that has very high transaction value with very slow velocity, okay? But also be incredibly valuable. So you really, I think there's a lot to learn there. I don't think we know all the nuances of it.
Rob, if we go back 20 years ago, it was all talk about eyeballs and a land grab. And I think a lot of people, we laughed because we couldn't quite picture, like we knew that the internet was changing the way that we might shop for a book or buying something online. But I think many of us didn't realize how important the internet would be to our daily lives. We didn't think about having an iPhone in our hand and how powerful that would be, navigating maps, like doing everything. So maybe you can put into layman's terms, I feel like blockchain is even harder for people to wrap their heads around. And this internet of money and trust, like what does that mean?
Well, ultimately, right, it comes down to this whole kind of who gets paid to do what and where the central point of failure is. Let me boil it down to this. So if I don't know you and you don't know me and we want to have a transaction, Andy, what do? We use a central institution of trust, a bank, a broker, your neighbor that we both know, okay? And it's pretty simple, right? What happens is I give the bank, the money. You give the bank, the object that I'm buying or whatever, the broker, and then they settle the trade. They clear the trade because we both trust them. What's the business model on that? It's pretty simple. The bank gets paid a cut. It's an old business model. It's worked throughout the generations, and this is how it is. What we're doing now is we're saying, no, wait a minute, that's a problem, because what happens if somebody hacks that bank, or worse, what if it's Lehman Brothers and they lie, or they package up a bunch of mortgages and it doesn't play and it blows up? These are central point, they're failures, they're problems. And so what blockchain does is no, we're going to use the network. What we're going to do is we're going to say, I'm going to announce to everybody in the network that Rob's going to give Andy $10, and you're going to announce to everybody on the network, I'm giving Rob, this stock, okay, for the $10. And then we do the transaction, we sign it with our keys, and then we ask the network, did that actually happen? And 50% of the network says, yeah, it happened. And oh, by the way, Rob didn't double spend the money. It's no longer in his wallet, which is a key thing. You don't want to, double spend it. And now all of a sudden, the network itself, the value, think of that. We just cleared the trade and we did it instantaneous, and there's no central point of failure. That's what we're talking about here. And you hear this whole thing called Web3, right? All Web3 really is instead of you being your name and your password, you're a wallet address now with a key, a private key and a public key. So imagine a world where when we did that transaction, I log into the system with my address, my bank account, my blockchain address, my wallet. You log in with yours. And when we make that transaction, the network clears it instantaneously. And that's really what we're talking about. And there's no central point of failure to that model.
And it seems the potential to have fees or the expense to go way down, because even today, the credit card networks, they charge a pretty good fee.
That's right. That's right. And they'll always be way, 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 way down. And here's another thing that happens. So a lot of people talk about NFTs. Oh man, these pictures and they're, no, it's not about the photo of the NFTs. That's like Beanie Babies, yeah, whatever. Okay. What it's about is the infrastructure around NFTs. What was really embedded in that is the royalty payout. So remember we had that transaction, right? Well, imagine if instead it was a transaction where there were a lot of people that needed to get paid. So maybe I have to pay the marketer. Maybe I have to pay the person whose website my offer was on. Maybe I have to pay the artist. Maybe I have to pay the paper provider. So let's say that if I create something that has a bunch of people that need to get paid, who get royalties for that transaction, now each one of those parties connects their wallet to the system so that when I do give you that $10 for that object, you're getting paid $8 and the guy over there is getting paid $1, whatever the royalty rates are immediately. So now,
okay,
right?
Here's a potential example I want to see if you can apply it to. Ticketmaster. Like there have been many artists who have pushed against Ticketmaster and their influence on live events.
Yep.
A lot of fans are fed up with convenience charges.
Yep.
How could NFTs change this centralization that Ticketmaster has?
Yeah, there's no reason for Ticketmaster to exist. I mean, an NFT system, okay, could immediately, and by the way, what it would do is it would allocate the money. Let's say, Taylor Swift says, I want to do an NFT for my tickets. She beforehand can say the venue gets paid X, the promoter gets paid Y. If the ticket is sold on your Twitter feed, you get paid, okay? And everybody gets paid a certain percentage based on what they did. You could gamify it. All that's built into a smart contract, a piece of code, so that when I decide to buy that ticket, the credit card processor everybody instantly gets paid. Now I get an NFT with a barcode that's unique to me. Okay. Now let's say I was fortunate and I managed to buy the Taylor Swift ticket and it was front row center and I'm not really that big of a fan and I decide I want to sell it. Well, fine. I turn around and sell it. Now, I just bought it for $10. You're not buying a Taylor Swift ticket for $10, but anyway, right? But I bought it for $10, right? And I decide I'm going to sell it for $10,000. Okay? So when I resell that ticket for $10,000, the same smart contract is still working. So guess what? All those people get paid their cut now of the $10,000.
Which does not happen today. Scalpers, they collect that margin, the markup, but the artist doesn't benefit.
That's right. That's right. And so what this is how profound, this technology is. We're looking at a company now. It's super startup, like Bootstrap, really cool, but it's aimed at kind of like the GoFundMe type of world. When you think about GoFundMe, right? You go to GoFundMe, you put up a charity, people donate, goes through the credit card processor, and they take a fee. That's about as centralized gets. Okay? You get your money, the credit card company gets the company, and GoFundMe makes their fee. Okay? Well, what if instead that offer for you to fund me was really just a smart contract that I can embed on Twitter, Instagram, Facebook, wherever I wanted it to? Okay? And when somebody paid me, whoever posted it, whatever affiliate, would get paid their cut. So if you put it on your website, you get a cut. But then I can embed that call for charity anywhere I want. That's what Web3 is all about.
Rob, what are the risks? Because we've seen that in this internet of trust, there still can be runs on the bank. It's just a different type of run on the bank.
Yeah.
It's like FTX ended up being a fraud, but there was a run on the bank. Or some of these DeFi projects, if people start, if trust becomes, if there's a loss of trust, suddenly there can be a run on the bank, and it still happens.
Yeah. So I first of all, FTX is no laughing matter. Okay. But I have to laugh. And the reason why and luckily I didn't get, burned. I know people that have been burned, and it's a horrible thing. But I will tell you, FTX failed not because of blockchain. In fact, if FTX used blockchain, it couldn't have failed. The issue with, and that's why I say I have to laugh. Here we are. We're building this entire decentralized system. We're building all of these networks with decentralized currencies, and everything is decentralized. And what's the first thing we do as human beings? We build a centralized exchange to trade on. Like you have to kind of you have to laugh at it. It's horrible. Okay, but that's how mentally how we are. It's kind of like the early days of the buggy whip. The whole story about the buggy whip manufacturer, right? He didn't see the car coming, right? Well, it's kind of like the same thing here. I believe, and what really needs to happen is the true adoption of blockchain, so that a bank run can never happen. We have a hedge fund called Cosmo Y we're launching. It's what it does is it invests not in Bitcoin, which is one half the market. We love Bitcoin, but on the proof of stake protocols, the other half of the market, where a lot of this institutional adoption is happening. And what we've done is we created this hedge fund that is basically risk managed, right? So the fund buys the coins. We stake the coins, so there's a yield component. Staking means getting part of those transaction fees I mentioned, and then we put a hedge in so that if the market goes down, you're mitigating that risk. We're actually taking the holdings of the fund and putting them on a blockchain, so that the investor is not only invested in the fund, but they can look on a public blockchain that says, here's what's in the fund, and here's where it's staked, and here's what the situation is in that fund. Full transparency in real time. That's where this market's going. Companies like Chainlink are doing that. Proof of reserves, you might have heard. But there's going to be proof of funds, proof of everything. And it's all going to go on, on the blockchain. And by putting it on that blockchain, what it does is it allows you to attest to the value, and the attestation is signed with a private key that only that person has. It's kind of like Ernst & Young signing earnings report and the balance sheet and the financials of the company. What are they doing? They're attesting to the health of that company, right? That's how it's done today. Imagine being able to do that in real time, not with a key, a signature, but actually a key that Ernst & Young or whoever held that signed that and put it on the blockchain so that everybody can see, yeah, Cosmo Y owns these assets at this time.
So you're not just a believer in blockchain as an investor, you're also a use case.
Yeah, absolutely. And in fact, those are the best investors. So we have this venture fund, Cosmo X, right? And it's a small fund, but we decided 3 years ago, Andy, to tokenize the fund. I got to laugh because all my friends that are venture capitalists, I was an EIR over at Highland Capital. Over the years, you build a pretty good network of venture capitalists. And they would all, laugh at me like, what are you, crazy? It's hard enough to raise money into a fund, but now you're tokenizing it? Like, how are you going to explain that? My mentality as an entrepreneur was, if I'm going to invest in this stuff, I should know how it works. And I should know what the problems are with it. So by being an early adopter of tokenizing Cosmo X, what it did was I know the workflow, I know the legal issues, And by the way, when I say legal issues, I'm not just talking US, I'm talking US, Singapore, Europe, every jurisdiction, because this is global. So I know all the legal, my team and I, we know the legal issues, we know the workflow issues, we know what companies are in the space, which ones are doing what tech, which ones work, which ones don't, what their product roadmaps look like. So now I'm informed all from deciding to tokenize my fund. So that when a big company calls me up and says, hey, we're thinking about tokenizing a fund, we want to pick your brain, I can say, absolutely. Let me tell you, you can pick our brain. Let's work together. Right. And so, yes, we are a use case. And that's the benefit of being a pioneer. We're an investor in a company called Archax, based out of London. And Aberdeen just did, we got in early, but Aberdeen, right, what are they, $500 billion asset manager. They just invested in that company, $20 million round. Why? Because what they're looking at doing is helping companies token, they're a digital bank, digital market for tokenized assets, because ultimately everything's going to become tokenized. Again, look at BlackRock CEO, Fink say, what did he say? Everything's going to be tokenized. Goldman Sachs, all these bigger companies are looking at tokenizing assets. What does that mean? All it really means, tokenize is just a fancy word. It's basically creating digital shares on a blockchain for everything.
Okay, so that we better understand, when you tokenize Cosmo X,
right?
What are the benefits?
So the benefits are near instantaneous settlement, total transparency, complete efficiency. So now what happens is that I can, you as a holder of that token can then sell it, all the KYC, AML, all of the whitelisting. In other words, if you're an accredited investor, you can only sell it to accredited investors. All that can happen on a blockchain. So what it does is it allows for you remember we were talking before about that royalty payout and that instantaneous settlement of everything? That's what it does. And it does it in a decentralized way. So now all these securities are being settled, trade, moved, and all of the royalty payouts, commission payouts, all of those things that are happen with those transactions are instantaneously cleared. So there is no, okay, I got to pay that guy this and pay a guy this and pay that. And by the way, because that royalty contract is being written in code, everything is legal from a perspective of, and a lot of times you get into situations where certain types of transactions are illegal. Okay, but they happen. Okay, and a lot of times it maybe happen because people don't know it's illegal. In this world, it isn't going to happen because you can't code it, because you won't be able to code it if it wasn't legal. You following me? So, a good example of that is a broker dealer has to sell a security. You can't. All right. So if I'm going to sell a securitized token, then it's got to go through a broker dealer. Otherwise, it's not going to trade. Those all they're built into the system here.
Any drawbacks to having it tokenized?
I think initially there'll be some drawbacks as, let's face it, there are always nefarious people who want to get involved in certain things and maybe find holes in the system that they can exploit. Generally, I call it kind of the early adopter drawback. In early days when systems emerge, somebody always finds an exploit, which would preclude from being too early, right? Which is why, timing is a hard thing.
What do you think it'll take for mass adoption?
Just time. I think little by little we're starting to see it. There are a lot of use cases that are permeating, and overall, I ultimately believe that you won't even know you're adopting it when you adopt it. Ultimately, that's where it has to be, right? It's kind of like you said earlier. We don't even realize how the internet has really changed our life, right? It just does. And I think ultimately that's how this is going to be, right? For this to be successful, I got news for you. People don't need to know what a key is or what a wallet is or what a blockchain is. They just need to know that my life is a lot, easier because of this.
Well, 20 years ago, it definitely paid to understand where the opportunities would be.
That's right.
Google, Apple, Facebook. Since you are an early adopter, for the average person, what should they be watching for in terms of opportunities that are, coming about today for the next 20 years?
Are you saying as an investor, what should they be?
Yeah, as an investor.
Yeah, as an investor. Yeah, I think, look, it's important as an investor to do your research, to understand this market and how it's changing. And then what I always say to people is focus in on what you know. In other words, if you're a video game guy, focus in on the applications of this in video games because you're going to be more likely to learn it. Whereas if you're in commerce or e-commerce, focus in on e-commerce because this is a technology that's going to touch every facet of our society, right? So let's boil this all the way down to really high level. Our entire society, the institutions of society, are built around trust. Governments are supposed to be about trust. Banks are about trust. Generally, if there's an institution created in society, it revolves around the idea of providing some form of trust. And now what we're talking about is using technology to make that more ironclad and resilient. And, it goes, think about even content, media. What do you trust? What don't you trust? How much of it is real? How much of it is not? How much is it hype? All of those kinds of things. My CTO, Ken Lang, calls it kind of the science of epistemology. He's a Carnegie Mellon PhD, multi-degree kind of polymath type of guy. But he's all about that kind of epistemology, which is really just the study of knowledge and trust. So I think we're going to start seeing, not to get real deep here, but you asked, how do you participate? I think that's how you got to do it. You got to learn and look at it in different markets. And then keep in mind, what are the companies that are in the space doing things? And what are the technologies? Because they're not all companies, right? Algorand out of MIT, a great layer one protocol, just like Hedera, doing a lot of really great stuff. There's no one company that's building Algorand. It's really kind of this, it's a network. And ultimately, the way you invest in Algorand is by buying Algorand because you believe that the value of that network would be going up. And the analogy, again, let's go back to that Facebook analogy. Imagine if Facebook was a network, not a company. The way you would capture value of that network and the way you would distribute value in that network would be through what? A Facebook coin, a token. The token represents what? The value of the network. So as the value of the network goes up, the value of that coin should go up. So imagine if everybody got paid in that. So if you took ads, you got paid in that. If you put something up, you would pay in that. That's basically what we're talking about here, right? So you kind of have to look at it and say, okay, if I'm buying this crypto, if I'm buying this digital asset, what I'm really doing is buying in the value of that network. And I believe that the value of that network is going to go up or down. Why would you buy? Or I'm going to use it, right? I'm going to use that network. And so in order for me to use that network, I got to buy the token of that network and I got to pay, right? It's like Ethereum, right? If I'm going to create a smart contract on Ethereum, I got to pay gas. I got to pay Ethereum, right, to perform my transaction. So I'm using the network to clear my trade, and I'm doing that by paying what? Ethereum. All the people on the network get paid, right, because they're staking and earning more. And as the value of that network grows, conceivably, the value of the Ethereum should go up.
That more clearly explains the rationale for owning different coins, more so than just scattering and diversifying and just randomly owning things.
Right. Exactly.
So I recall a time, internet focused, that there was the narrative that the internet was going to put all brick and mortar out of business. And similarly, I hear that, blockchain, there's not going to be government anymore. There's not going to be banks anymore. What does our future look like?
There absolutely will be banks. There absolutely will be government. What blockchain will do is make those institutions more efficient, more transparent, and more trustful. And by doing that, they can then concentrate on the real value that they should be providing, right? There's no value provided by going to an ATM machine, taking out $100 and spending $3, 3%, okay, to take that cash out. None. That, in my mind, is robbery. It's robbery, okay? Whereas if a bank provides me a loan, or if a bank sources capital to provide me a loan, or if a bank officer gives me advice on how to structure a bunch of loans, if I'm a company, at different rates for different situations, those are all valuable things. And so ultimately, value will be more commensurate with value, or fees will be more commensurate with value received. So, government should be, technology isn't going to replace human beings. They're not going to create, ultimately, what does an investment banker do, right? A lot of it is relationships and creating relationships and bringing in funding and bringing people together and connecting people together. Those are all high value things. So I don't see that going away. The fact that voting in America is done the way it is done today is ridiculousness, right? That could so easily be done on a blockchain. Anybody that argues against it ultimately is probably politically manipulating. Because otherwise, why would you argue against it? If you argue against it, you're gonna think that it's going to give you a disadvantage. And how could transparent, true voting give somebody a real disadvantage? Well, you're probably banking on it not being.
Very thought-provoking. Rob, I like to ask all the Inspired Money guests, how do you define success?
I define success with happiness. So, entrepreneurs are all progressive people. They're always kind of seeking to come to the next level, right? They're always like, well, I got that hurdle. What's the next one? Yep, I got that one. Right? We all tend to be that kind of mentality. For me, success is really about working with the people you love to work, and ultimately being in the position to create. To me, that's success. I look at people who society would deem to be incredibly successful, and they're miserable, and they don't know how to smile. And they're consumed by, those achievements. To me, that's not successful. And it's a hard thing to meditate on, because you get caught up in it, right? You're like, oh man, they got this problem and that problem. It's never easy. Nothing's easy, right? But anyway.
Well, thank you for spending time with us and sharing your passion for entrepreneurship, for blockchain, for investing. Tell the Inspired Money Makers where they can follow you and learn more.
Yeah, I'm at Rob Frasca on Twitter. My Cosmo Ventures is our company website, and we have two funds, Cosmo X and CosmoY.com. And Cosmo, by the way, just a little side note. So Cosmo is named after Cosimo Medici. And as you know, the Medicis invented banking as we know it. So it's a tribute to the old scroll 1420 Banco Medici, changing to the new world of blockchain and banking.
I love it.
CosmoVentures.com.
Thanks, Rob.
Thank you. Appreciate it.
So what was your favorite inspired money moment? Rob has really enjoyed a lot of upside riding the waves of the internet and mobile. Time will tell if his bets on blockchain and crypto will hold the promise that he thinks it does. I admire him for his enthusiasm and his conviction. My favorite inspired money moment is the idea of valuing a network and how that's tied to the value of a coin. If that's our future, our price to earnings ratios and cash flow, are those things of the past? We will see. If you had a different favorite inspired money moment, please post a comment or share it in the Inspired Moneymakers Facebook group at inspiredmoney.fm/Facebook. Thank you for tuning in to the end. Be sure to subscribe to my email that goes out every 2 weeks. It's investment focused, and the Runnymede investment team highlights data, news, and events that we think are worth sharing. Subscribe at inspiredmoney.fm/newsletter. Thank you for joining me on this mission. Have an inspired week and do something that scares you, because that's where the magic happens.